The new formulation removes any possible ambiguity and resolutely conveys that 2% is not a ceiling.
The deal that is on the table now, and that was agreed by 131 countries around the world through the OECD G20 inclusive framework process, is a very fair deal that will improve the system.
Bankers, young bankers who decide that they're working too hard, they should choose another living. It's my view. These are hard jobs. You want to be a doctor, you're going to work hard when you're young. You want to be a banker, you're going to work really hard when you're young.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
A lot to unpack there. Good morning and welcome to Bloomberg Surveillance Early Edition on Friday, 9th of July. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Taxation Revolution. The world's richest nations meet in Venice, setting the stage for an overhaul of corporate taxes. We're live at the G20. Asia becomes the epicenter of market fears over a slowdown as tensions between the U.S. and China mount, and Beijing stifles its tech sector with a crackdown on big data. And coming up in the next hour, we'll be joined by the S4 Capital founder, Martin Searle, BlackRock Vice Chairman Philipp Hildebrand, and the WHO Chief Scientist, Soumya Swaminathan. Now, the Biden administration is stepping up its condemnation of China over Xinjiang. According to a report, the U.S. will add at least 10 Chinese entities to its economic blacklist as early as today over alleged human rights abuses in the northern region. This comes as China steps up its probes into domestic tech companies and clamps down on the ability for Chinese companies to list abroad. Well, joining us now to discuss all of this is Enda, Curran, our Chief Asia Economics Correspondent in Hong Kong. Enda, thank you so much for being with us. First of all, is this an escalation between the U.S. and China, and is it a significant escalation?
Well, it's certainly another example of the tit-for-tat tensions that we're seeing play out ever since the Biden administration took over in January, Francine. This latest move, if it goes ahead, and we don't have the full details yet, but the idea would be that you block those U.S. companies dealing with whatever Chinese companies are on the entity list. Essentially, if you want to do business with them, you have to get permission from the Chinese government. It's one way the U.S. has been trying to exert control over its dealings with China. The other main channel, of course, being sanctions. The US has also banned certain imports from Xinjiang, for example, cotton and tomatoes, and that's all about that's because the US is forcefully pursuing the allegations of forced labor in Xinjiang, of course, along with the other tensions over the crackdown in Hong Kong, for example. So at the very least, you'd have to say it does add to the idea that these tensions between China and the US are, if instead of going for an off-ramp, certainly continue to be on the trajectory that they were when President Biden took over back in January.
And overall, I mean, we also see this massive crackdown on Chinese technology companies. Does it fit into, a single narrative of just China trying to be much more present, much more in control of their companies and almost tolerating no dissent?
I think there's an element of, China pushing for self-reliance now. They are aware they are in these big technological crosshairs with the US. That's not going to change. So when you think about 5G or AI or semiconductors, China knows it has to get it on its feet, on itself a bit more. So they're going to push for tech companies to stay closer to home. They want to keep control of their own data in the same way that the US, of course, has become very wary over who controls, what foreign entities controls, what consumer data. So China's firing back in that respect. And of course, it should be said that when it comes to the US pressure on China, China always rejects those criticisms from the US. They say they've got no right for interference in their own internal affairs. So China does seem to be bolstering its defences. Its new industrial plan does speak to bolstering its own technological industries somewhat. And I think that's a theme we're seeing playing out now. Some people refer to it as decoupling. I don't think we're seeing outright decoupling between the two economies yet, but we're certainly seeing something of a schism on the technology front, that's for sure.
Enda, thank you so much. Enda Curran there, our Chief Asia Economics Correspondent in Hong Kong. Now, finance ministers and central bank governors from the G20 are meeting in Venice this weekend. Top of the agenda is the 15% global minimum corporate tax agreed at the G7. Now, the group's formal endorsement will be a key milestone after years of talks. Well, joining us now for more is our Maria Tadeo in Venice. Maria, I know the background is beautiful and it's probably nice to be back on the road. What are we actually expecting on tax?
Yes, salve, Francine. And look, this is, of course, a meeting where the focus will be very much on that OECD tax, which they say is nothing short of a revolution. You mentioned this is about the tax rate of at least 15%, but also, and perhaps even more crucially, would give the right to countries to tax big American tech companies in the countries where they make their profits. So it could put an end to that profit shifting into low tax jurisdictions. Now, it is interesting, Francine, that we did speak with Bruno Le Maire, the French finance minister, and he said, when we look at this is a full package. We need to get both elements in the final deal. Of course, that is a warning to the Irish government. They argue that they could work with the tax relocation, but they cannot accept that 15%. So again, it's not a given deal that we will get to full consensus by the end of the week. Having said that, they do argue if the big 20 economies of the world do come together, that is immense pressure on countries like Ireland to shift their position.
What would this actually mean, in concrete terms, Maria, for big tech?
Well, Francine, what they argue is that, in fact, this is good news. I mean, they were expecting this. It's not a surprise. Big tech did know that the political mood had really changed, especially after Donald Trump left the White House. So they were expecting this. And what they argue, and you could argue this is to some extent spin, but they do say that they welcome the move. It's easier to deal with a global deal with global taxation and not go for individual countries putting forward their own digital tax. So they say they welcome the move, and it's probably going to be easier from now on to tax big tech. What critics argue, however, is that ultimately these companies are always very good at reducing their tax bills. So we're talking about 15%, but in practical terms, of course, you could argue they will try to find ways to make it smaller.
Maria, thanks so much. Maria Tadeo there in Venice. We'll get to Maria throughout the day. And Maria, I also can't wait to join you in Venice because I'm traveling this afternoon. Coming up, smart conversations on the early edition this hour. We'll talk global tax with BlackRock Vice Chair Philipp Hildebrand. We'll also talk about the spread of the Delta variant with the WHO Chief Scientist Soumya Swaminathan. In the advertising opportunity of the year, the Euros final, the S4 Capital founder Martin Searle also joins us. So if you have any questions for any of our great guests, just write to us on @IB Plus TV Go. This is Bloomberg.
We need to take into account the fact that in this digital and global world, we can't have the taxation system that we had 1 century ago. So we need the big multinational to pay taxes where they are doing profits, and we need to avoid it race to the bottom, these tax havens, and have a minimal effective taxation all over the world.
That was the European Economy Commissioner Paolo Gentiloni speaking to Bloomberg. Maria today there at the G20 summit in Venice. Now, global tax, of course, top of the agenda at this weekend summit. We'll have plenty more from Italy throughout the show, including our interview with the BlackRock Vice Chair, Philipp Hildebrand. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. A large UK study has found most young people face an extremely low risk of illness and death from COVID-19 and have no need to shield from the virus. The research found under 18s in England had about a 1 in 50,000 chance of being admitted to intensive care with coronavirus during the first year of the pandemic. Conditions that were previously thought to increase dangers like active asthma or cystic fibrosis brought a very little risk. Now, job openings in London's finance industry are almost triple the level of a year ago, ahead of the UK's exit from COVID restrictions later this month. According to data from a recruitment firm, Morgan McKinley, there were more than 3,300 jobs available at the end of last month, the highest level since January 2019. Pfizer says it will request a U.S. emergency authorization in August for a third booster dose of its COVID-19 vaccine. The move comes after early data shows that it can sharply increase immune protection against the coronavirus. The company has received initial data from an early human study showing that a third dose of its existing vaccine is safe and can raise antibody levels by 5 to 10-fold compared with the original vaccine. And becoming an investment banker requires an enormous amount of work. That is a warning from Cantor Fitzgerald CEO Howard Lutnick. He says junior bankers complaining about long hours should rethink their choice of career in the industry.
Bankers, young bankers who decide they're working too hard, they should choose another living. It's my view. These are hard jobs. You want to be a doctor, you're going to work hard when you're young. You want to be a banker, you're going to work really hard when you're young. You should know it going in and make those decisions in life. To complain about it after you got this great job, I don't know, it just seems a little silly to me.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. I'm so on the fence. I know you have to work hard for it, but it also can't be inhumane. Up next, S4 Capital founder Martin Searle joins the program. We'll talk about the impediments to the global recovery. We'll talk corporate tax and maybe also a spot of football. Any questions, write to us, IB Plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Biden administration is stepping up its condemnation of China over Xinjiang. According to a report, the U.S. will add at least 10 Chinese entities to its economic blacklist as early as today over alleged human rights abuses in the northern region. This escalation in geopolitical tensions is another hurdle for the global recovery as concerns grow about the impact of the Delta variant. Well, joining us now is Martin Searle. He's chairman of S4 Capital. Martin, thank you so much for joining us. I have a lot of questions, of course, about advertising. We'll talk about football. But first of all, do you worry that the recovery is going to be quite uneven, that it's much more difficult to see the exit out of COVID-19 if you look at China, for example, as a template?
Well, yeah, the digital economy, as far as we're concerned, the digital media economy, which last year was about $600 billion, and then you've got marketing services, $500 billion, and then trade budgets about $700-800 trillion. There's a two-speed economy there. The traditional media are under pressure and continue to be under pressure despite the bounce back. The digital economy in which S4 operates continues to develop and flower, and the pandemic, good or bad reasons, has accelerated all the trends around the digital economy. So the answer to your question, Francine, is we see no slowdown. April, May, and June. I think I've said this about 2 or 3 months ago. Never in my 50 years in the business have I seen such strong organic growth. And so with relatively little inflation, at least yet. I mean, if you go back to the 1980s, which you won't remember, but I do, we had strong growth, not at these levels of 5 to 6 GDP this year and 4 to 5 next year, but we had significant inflation, so real growth was much less. So the answer to the question is we see no slowdown. April, May, and June are being extremely strong. The pipeline for July and the rest of the year are very strong. We gave market guidance,
and so
35% organic growth. It will get even better than that, is my view. So it's very strong.
I mean, there are a couple of questions, Martin, that we're looking at in the markets, and I don't know whether they're sinister or they look at as some kind of downturn on growth instead of inflation, which the real economy hasn't seen yet, or whether it's just because of all the accommodative monetary policy that markets are having a bit of a wobble.
Well, you get these wobbles. Like yesterday, I had a wobble because people were worried that the growth was going to stall, as you're laying out. This morning, maybe it's a little bit different. So we vary from one to the other. We have two tailwinds facing or providing growth for us. The first is GDP growth and the monetary and fiscal stimulus, which you point out, can't carry on forever. So I've said before, I'm worried about 2023, 2021, 21 and 22 strong, 23, there must be a correction and a reversion to the pre-COVID growth. That's one tailwind. The second tailwind, as far as we're concerned, is digital transformation. That doesn't slow down as a result of variations in GDP growth rates or fiscal and monetary stimulus. In the pandemic, the paradox was that digital transformation speeded up. Consumers accepted digital transformation faster. The media, as you well know at Bloomberg, speeded up faster. Streamers, the pressure on linear TV, the growth of digital outdoor, and last but not least, the change agents inside companies who were pleading for their management to change and speed up digital transformation. Q2 of last year blew a hole in profits, so people said we might as well get on with it. So you have to differentiate. When you look at our industry,
depending on where you are,
you have to look at. It's a tale of two cities, or there's a two-speed economy. Traditional under pressure, digital continues to pound forward. It will be 70% of the. It will be 70% by 2026.
A lot of the focus will be on digital tech, so I don't know how much pressure you're expecting on some of these big tech giants actually going forward, and what that means for the digital economy. I mean, at the margin, does it actually make a difference because their profits and revenue are so big?
Well, you have to understand that we look at the digital economy. We follow about 25 companies. I won't, in the interest of time, go through every one of them, but we look at the big 6 platforms: Google, Facebook, Amazon, Tencent, Alibaba, TikTok, and we see now other companies like Kaoshu coming through. ByteDance and TikTok has had a very strong increase in their revenues. Twitter, Snap, and Pinterest, although important, are much smaller in the digital ecosystem. But it's about Apple and Microsoft, Adobe, Oracle, and Salesforce and others. So we look at all of those. The relative merits of those and the relative strengths and weaknesses of those are not particularly important to us. What we have to do is figure out, on behalf of our clients and with our clients, how we operate in the digital ecosystem. We go to market as faster, better, cheaper, agility, understanding the digital economy and doing it efficiently. Understanding the digital economy, it means about understanding the toing and froing. There will be more regulation. There is more regulation on the big tech giants, which you would expect. When companies pass $1 trillion of market cap or $2 trillion of market cap, they are as big or bigger than some nation states. And it's only natural for those nation states to start to put the pressure on, particularly when we've gone through the pandemic.
Right. What does this mean for S4 Capital? Are you going to be acquisitive? How much, I know when you come on, we talk about how big and how ambitious you are for the group.
We are. We're at the end of the 4th month of the year, April, we were up 91%, about half organic and half through deals. And that has continued to be strong through May and June, and we say into the second half of the year. We will continue to be acquisitive. I think we've signed currently about 4 exclusive LOIs. So you will see us continue the level of deal activity. I would say we will probably add a 3rd leg to our business. We're in digital advertising content. We're in data and analytics and digital media. The 3rd area will be technology services. So we will have a full end-to-end suite of services to compete against our core competition, which is really Accenture. And we will have a full suite of services. It's not really the holding companies or the specialists that we compete against. We compete against full-on against Accenture, maybe Globant as well, but they're more in the tech services area.
Martin, on the football, I know you're supporting Italy. But apart from that, does it actually?
I'm conflicted like you. I went to Germany and to Denmark, and I'll go on Sunday. And if I'm a little bit hoarse, it's because of what happened on Wednesday night.
Okay, Martin, what does it mean? I was looking at some of the audience figures. I mean, it was pretty incredible. Is football back? What does that mean for advertising if we have the sports? I mean, Tokyo's not actually having any spectators. Does it impact advertising around it?
Well, hopefully it's back and coming home. But no, look, I was talking to another network about the Olympics. I think there's, look, the TV coverage, NBC will switch their coverage to examining what happens inside homes of athletes and fans, not just in Japan, but around the world. The audiences, I had an email from a German journalist that said that the reception to the Euro 2020 or 2021 was muted. And I said, well, that was a little bit to do with performance. I think Germany was disappointed with the performance of the German team. Obviously, it's had a very, very significant effect here. And I'm assuming in Italy, you'll find out, Francine, when you go to Venice shortly. But,
right.
You know, look, it is good
Martin,
for
your
ratings.
prediction?
These events do help the general advertising environment, particularly digital. Olympics will be really interesting this time round because the digital Olympics will flower. And then, you know, we have Paris and Los Angeles coming. We'll have Brisbane in 32. So I think the prospects for the Olympics after Tokyo and Beijing will not be easy either. It's in February of next year, the Winter Olympics. But I think the IOC is a very strong brand, 15 top sponsors, 6 of them are tech. I think there will be more tech sponsors, Alibaba heavily in there as well.
Martin,
so you'll see.
Thank you so much. I saw TikTok all over the UEFA Cup. Thank you so much, Martin Searle, there, chairman of S4 Capital. This is Bloomberg. Taxation Revolution. The world's richest nations meet in Venice, setting the stage for an overhaul of corporate taxes. We're live at the G20. Asia becomes the epicenter of market fears over a slowdown as tensions between the U.S. and China mount, and Beijing stifles its tech sector with a crackdown on big data. And coming up on the program, we'll be joined by the BlackRock Vice Chair, Philipp Hildebrand, and then the World Health Organization Chief Scientist, Soumya Swaminathan. Well, good morning, everyone. I'm Francine Lacqua in London, and welcome to Bloomberg Surveillance Early Edition on this Friday, the 9th of July. Now, finance ministers and central bank governors from the G20 are meeting in Venice, sunny Venice. Top of the agenda is a 15% global minimum corporate tax agreed at the G7. Now, earlier this morning, the French finance minister, Bruno Le Maire, told Bloomberg that an agreement is possible.
I'm very confident, and I think that we could have, during this G20, a groundbreaking agreement on international taxation. And you know that France has been pushing for that international agreement for more than 4 years. So we are on the verge of having this agreement. It would be good news for all G20 member states. It would be also good news, I think, for the rest of the world.
Well, joining us now from the G20 in Venice is Philipp Hildebrand. He's vice chair at BlackRock. Philipp, thank you so much for joining us, and welcome to Venice. I know you just landed in sunny, and what a view you have behind you. You also, Philipp, at BlackRock actually came out with the second-year outlook, and this in kind of the market turmoil that we saw in the last couple of days. What do you think will be the biggest pitfall for markets from here until December?
Good morning, Francine, from beautiful Venice. Look, I think the biggest risk remains COVID. We need to accelerate vaccines, administer them, and I think very importantly also think about the developing countries. Right now we're doing reasonably well, stalling somewhat. The effort has to be just to continue forcefully to administer the vaccines.
Is there a danger that actually markets are not worried about inflation, but they're worried about growth? And if you look at China and if you look at other parts of the world, we should worry more about what kind of recovery we will see than currently priced in?
I think if you look at the developed world, I'm convinced we have a restart. It's real, it's powerful, and it's rapid. In fact, looking at the U.S. economy, it looks to me as strong as it's been in decades, frankly, generations. So I'm not worried about growth. I think we're going to see very, very strong growth numbers. We are also going to move into a higher inflation regime. The collaboration between monetary and fiscal policy that has allowed us to bridge COVID will lead us into a higher inflation regime. It will take some time to settle, so I don't think we should pay too much attention to the very short-term numbers. but inflation will move higher as we kind of go through this transition phase.
What's the most surprising thing when you look at the mid-year outlook and you're really looking beyond the restart and maybe some of the legacy of COVID and how our economies will differ? What surprised you the most in this, Philipp?
Well, I think we have an unusually wide range of views right now, both frankly internally at BlackRock amongst our portfolio managers, but you can also see that across the market. So, that leads to the market is looking for which of these outcomes turns out to be the most likely one, and so we should expect to see some volatility as we move forward. I think the biggest issue, the biggest longer term question is, can we get through this restart? Can we implement these no monetary policy regimes that have been adopted by the major central banks without unhinging long-term inflation expectations? That will be, over the next 3 years, let's say, the most important challenge the central banks will face. And as we proceed into this restart, the market will begin to focus on that.
And Philipp, you basically suggested there's a wide range of potential outcomes. Again, if you go back to the markets and what we've been seeing in bonds over the last couple of days, does it mean that a lot of people can make money but also lose money quite quickly, given how markets are priced right now, that bonds are going one way or telling us one thing and the rest of the market something else?
I think because we have a wide range of potential outcomes longer term, it's going to be very hard to time the market in a short-term trading kind of sense. This is what happens when the market is trying to calibrate itself and look for the right path. There's going to be a lot of movement back and forth, as we've seen. So I think that the most sensible thing to do is to not pay too much attention to the very short term, to the 24-hour news cycle, and really focus on the big story. And right now, that will be the restart. I think we're going to see some easing signals coming out of China. That's a very important macro signal. And then, as I said, longer term, the big question will be, can we pull this off without unhinging or undermining long-term inflation expectations?
What does China actually mean for BlackRock? Is it an investment destination, or do you worry about some of what we've heard this week, which is a crackdown, for example, on technology, but also the kind of reversal that you were talking about that PBOC has done to support the economy?
Yes, China is a very important part of the story. It's a huge part of the global economy. Most investors are under-allocated to China. If you think about the long-term allocation, that long-term allocation will go up. It's inevitable as China represents such a big weight. At the same time, there's a risk premium attached to some of the strategic tensions between the U.S. and China, as well as some of the issues around the tech sector, the interference of the state in the marketplace, in the economy. And we have seen these recent slowdown signals, which again I think will now lead to an easing of policy, which will be a very significant development on the macro side. So I think these announcements the last few days coming out of China are actually potentially more important or equally important as some of the tensions we've seen around the Chinese tech companies.
Philipp, do you worry? If you look at U.S. China tensions, I don't know whether that's less worrying than some of the global supply chain issues or access to chips that we've seen, and whether that is probably the biggest risk for the economy, and again, what that translates into for central banks.
It's a tension point, undoubtedly. It's a risk factor. At the same time, these economies now are so integrated. When you compare this to the Cold War, where we had equal sort of tensions between the Soviet Union and the United States, at the time the Soviet Union was a fraction of what China represents in the global economy. So both sides have an inherent and profound interest to manage these tensions. They will be with us for a long time, perhaps for a generation, but you have to believe that they can be managed and will be managed simply because there's so much at stake. There's such a deep degree of economic integration now between these two economies, and China is very big. China is a big part of the global economy, much bigger than the Soviet Union ever was, even during the height of the Cold War. So I think it's a different setup. It is a risk, and investors will take that into account as they look to increase the allocation to China. in the long term. Again, if you just look at the facts today, there's no doubt that investors are, broadly speaking, underallocated to China from a diversified portfolio perspective.
How are you feeling about Europe right now? And I want to ask you a little bit about, Philipp, the European banks. But in general, is the European economy holding okay? It doesn't have enough, or it doesn't have as much stimulus as the U.S., and we have some very important elections coming up later this year.
I think the economy looks good to me. It's going to be strong. We're going to see the same restart dynamic that we're seeing in the U.S. It's lagging a little bit. The vaccinations are running behind a bit. But essentially, it's going to be the same story. I think there are some very positive developments in Europe. The recovery fund is a powerful vehicle. If you look at the sums of money that will be invested in countries like Spain, Greece, and Italy, these are extraordinary opportunities to change the path of longer-term growth in these countries. And I think that's the real historic opportunity that Europe now has for the first time in a long time. Thanks to the public sector, thanks to the policy response during COVID, we're going to have the ability to see huge investments being made from the public sector, hopefully also incentivizing private capital to move. So I think there is a story here that looks very attractive for Europe, provided, and this is the key point, that these public funds are invested in a way that enhance long-term growth potential and enhance long-term productivity potential in the European economy. But I remain, frankly speaking, quite optimistic as far as Europe goes in these, as the months proceed and as the restart proceeds.
Philipp, is it at the start of or mid-2022 that we'll see whether there's finally appetite for cross-border, banking consolidation in Europe?
Well, look, this is a topic you and I have discussed for years, unfortunately. There is not going to be a better time than this restart period, let's say the next 18 months, for the European authorities to really complete banking union. There is going to be no better window than now. We're going to see very strong growth numbers. We're going to see, a moderate response, if any, from the central bank, even if inflation will rise, which is what I would expect. So this is in a way going to be almost a sweet spot for completing the unfinished business around banking union. And once you have that in place, if the recovery continues and if we do see some pickup in potential growth beyond the restart, then I think it could become very interesting for the banks to look at growth opportunities. They have been in retrenchment mode for years now. They've been in business model repair mode. It is time to get back into growth mode at some point over the next couple of years. This is the window to do that.
Philipp, when you look at the new strategic review, actually from the ECB yesterday, how much of a game changer is it for the economy, but especially for the market? So, the ECB president will have a communication challenge on July the 22nd, but does it actually mean that they could be much more accommodative for longer, or is it still all to play?
I think what came out to me looks very sensible, and frankly, we should commend the president for having done this in the way she did, in getting full consensus behind these deliberations. These are difficult moments for a central bank, and the last thing you need is divisions within the council. She managed to do this, I thought, very effectively. The outcome to me is sensible. It's a bit more cautious than the Federal Reserve's new framework, so it doesn't have an explicit kind of make-up strategy dimension, which again I think is sensible given the European history and the European sensitivities, as well as the mandate of the central bank. At the margin, it gives more room, but I think at any rate we have to assume that the policy response is going to be very muted going forward relative to what history would suggest when you look at where inflation is going to go. And that's true for the U.S., certainly, very much true for the U.S., but I think it'll be true also for the ECB. And the new framework at the margin could contribute to that, but I don't think it changes the path fundamentally. It re-emphasizes that they will not make the mistake the ECB made in 2011, that's for sure.
Philipp, thank you so much. Philipp Hildebrand. I mean, Venice is so beautiful. I can hear the cicadas, Philipp, and at the same time, I can also hear helicopter landings. So I don't know whether that's Janet Yellen or Larry Fink. I hope you'll report back. Philipp Hildebrand, vice chair there at BlackRock. Now, coming up, as the coronavirus continues its resurgence with the rapid spread of the Delta variant, we speak to the chief scientist of the World Health Organization, Soumya Swaminathan. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, coronavirus continues its resurgence across the world with the rapid spread of the Delta variant. India has approved a $2.3 billion response fund to fight the country's devastating second wave. At the same time, Indonesia is receiving aid to help meet a shortfall of oxygen supplies amid a surge in hospitalizations. Now, in Korea, the government is raising curbs on social distancing to their highest level. Well, joining us now is Dr. Soumya Swaminathan, the WHO chief scientist. Thank you so much, Doctor, for joining us for this really important conversation. First of all, do you think, Doctor, that the evolution of COVID has slowed?
I wouldn't say that at all. What we're seeing now is, of course, a diverging pandemic or a dual pandemic. There are parts of the world where vaccination coverage has reached the point where there is a slowdown, certainly of severe cases and people being ill enough to be hospitalized. But there are large parts of the world, and you were just naming a few countries where there are surges, where there's oxygen shortages, where there's a lack of beds and increasing mortality. In the last 24 hours, we've had close to 500,000 new cases being reported and about 9,300 deaths. Now, that's not a pandemic that's slowing down. Yeah. In fact, in 5 of the 6 WHO regions, cases are rising, and mortality in the African continent has gone up by about 30 to 40% in the last 2 weeks.
Yeah. Doctor, have you seen any new variants that could have resulted with, us vaccinating populations whilst cases are going up?
So, there are several reasons for why this is happening. Why are globally cases going up, and why are so many countries seeing a steep rise in cases? And I should add that these include countries that have unvaccinated populations and countries that have vaccinated 30, 40, or 50% of their population. So the reasons are the Delta variant is certainly the most transmissible, the most dangerous variant of the virus that we have seen so far. In fact, the original virus, if one infected person could spread it to 2 or 3 people, this variant, the Delta variant, one infected person can infect 8 people. They're also infectious for longer. So that's the first reason. The second is increased social mixing, what's called pandemic fatigue. People are getting back to their normal lives, either by compulsion because of economic reasons or otherwise. And third is the relaxation of public health and social measures. We've seen many countries and sub-regions and countries dropping all of the measures, including masking and physical distancing. And the fourth is the slow pace of vaccination globally. So these are the things that are contributing to the rise in cases that we're seeing over the last 2 to 3 weeks.
But is it likely that we'll see new variants in the coming months or quarters?
It's quite possible. We cannot predict, but the virus is evolving and mutating all the time. So we're already seeing within the known, like within Alpha and within Delta, we're seeing additional mutations, which can be quite dangerous. They could confer properties where the virus actually becomes even more resistant to vaccines. So, of course, the worst case scenario is that the virus becomes resistant to the existing vaccines, which has not happened so far. There's been some impact on the vaccine efficacy, but most of the vaccines that are being used are still highly efficacious against severe disease. But this is something we cannot predict. So it's really a race between getting our populations covered through vaccination and maintaining the measures till then to prevent the surge in cases. Because we know that the more the transmission that's happening, the more easily the virus can only mutate when it's actively multiplying and transmitting. So that's the way to stop further variants from arising.
Doctor, do we need boosters actually in the fall? And how do developed nations square that with only 10% of the developing nations even having gone through their first shot?
As you rightly said, we at the WHO are focused on trying to get 10% of every country's population vaccinated and protected by the end of September. That's within the next 90 days, and 40% by the end of the year in every country. We don't want to see some countries with, getting close to 70, 80%, and somewhere not even 2%, not even the frontline workers are vaccinated. The need for boosters, depends on the science, and the science, of course, is evolving. What is encouraging is that many studies now are showing that immunity seems to last quite long after a course of vaccination. It seems to last for 8 months. There are some data now up to 12 months where people have been followed up in the vaccine trials, and you have both the antibody responses as well as what we call the cell-mediated or T-cell responses. So it does appear that immunity could be long-lasting and that we may not need a yearly booster. On the other hand, there may be subgroups of people, the elderly, for example, or those who have other underlying diseases, immunosuppressed people who cannot mount a good immune response, who may need more frequent boosters. And there are going to be now studies, I think, happening to look at what happens over a period of time, both in people who do not receive a booster and perhaps in some who do. So again, there's no clear evidence at this point that we're all going to need boosters, which is a very good thing. But right now, the focus is let's get people vaccinated, those who haven't had their first course.
How do you feel about governments actually offering rewards for people to get vaccinated? Is that a slippery slope?
Well, again, it makes me sad because there are countries where people are waiting, are really dying, in fact, are waiting for the vaccines. And there are other countries where people are being given all sorts of incentives and gifts. We're not against that in the sense that you have to do what you need to do to get that vaccine coverage rates up, because that's what's going to reduce transmission, really bring this virus down where it's not having an impact on society. But, we need to understand what's driving either a lack of enthusiasm or hesitancy. In some cases, it's just practical things like, just getting vaccines close to people, making it easier, getting friends or relatives or a helper to come and help you if you're not able to go yourself to the vaccine center, providing that additional bit of information, answering the questions that people might have. In many cases, I think it's those things, and it varies from place to place. It's very contextual. We know that there is vaccine hesitancy, there are conspiracy theories, etc. But in the majority of people, I think they have some questions that need to be answered, and perhaps some incentives, some practical things that make them, come forward. But again, there are large populations that are waiting to get vaccines, and so that's where then we start seeing these inequities.
Thank you so much for this conversation. Soumya Swaminathan there, the WHO chief scientist, joining us this morning on variants and COVID. Coming up, we'll get back to the markets after Jens Weidmann softens the tone of the ECB's strategy review. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. A lot of the focus, of course, is on the markets. We had a good conversation with Philipp Hildebrand about what exactly he's seeing in the markets. U.S. equity futures pretty much steady. Treasuries halting an 8-day rally. And then if you look at Europe, they're kind of gaining. The big one to watch out for is, of course, the 10-year German bond. And you can see they're practically unchanged after the ECB review yesterday. This is Bloomberg.
If it now is the case that the marginal rate of recovery is going to be weaker than what everybody's forecasting, the markets are going to adjust.
For better or worse, we might not get clarity around that growth picture until later in the summer, September, that we're into a period where some of the data may be a little bit mixed until we see more clarity a little bit later on in the year.
The market is treating the hawkish noises from the Fed as essentially a policy mistake.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, July the 9th. Our top stories today. Blacklisted, more Chinese entities reportedly will be barred from doing business with American companies because of Beijing's alleged human rights violation. The G20 gets on board. Finance ministers from the biggest economies are set to endorse a landmark global tax overhaul. And still betting on bonds while treasuries end an 8-day rally, and some of the world's biggest money managers say there will be a swift comeback for the battered reflation trades. So good morning, everyone. I'm Francine Lacqua with Matt Miller and Danny Berger. Kailey Leinz is off this week. Matt, there was quite a lot going on in the markets this week. So as we kind of round off the weekend this Friday, we look at what we heard from the ECB strategy review. It didn't make much of a difference, but they may have a communication concern coming up on July the 22nd. And then the other focus, of course, still, yet again, inflation growth and the reflation trade.
Yeah, it seems like things are kind of on autopilot here in terms of the ECB. They can raise their inflation target if they want, but they're still terribly unlikely to hit it. And they do have Jens Weidmann at the Bundesbank saying they're not going to push for higher inflation than 2%. Take a look at what's going on in Asian markets overnight. There was no soccer, so we're all fresh this morning and ready to rock and roll. But nonetheless, we see a lot of selling going on in Asia. It's not the huge drops that you may be concerned about, but if you look at the MSCI Asia Pacific Index over a year-to-date period, we briefly lost gains. So really not doing well compared to other regions where we're almost at highs in Europe, at record highs in the U.S. minus yesterday. You can see Tencent bounce back a little bit, up 2%, actually adding the most points to the MSCI Asia Pacific Index. Alibaba is still down, but not a big drop, 0.9%. It is obviously a very big company, so that makes a difference on the index. And I noticed that, you know, the dollar, the Bloomberg Dollar Index, not moving very much, but the dollar is stronger against the yen, it's stronger against the euro, and stronger against the pound. So maybe getting a little bit of strength back against some of these currencies.
Yeah, Matt, it does kind of seem like the only place that you still have kind of that risk aversion is in Asian equities, because, I mean, look what's happening here in Europe. It's the opposite of what we saw yesterday. We're clawing back at some of those losses. You have France, for example, one of the best performers, up 1.7%. You have UK stocks up 0.8%, despite the fact we got growth figures out of the UK today that showed that rate of change that everybody's concerned about is slowing when it comes to the GDP figures. At least wasn't as fast as many people had expected. But on a headline level, we are higher today in Europe by 2.5%. Again, this is at least when it comes to travel and leisure. Now, this is kind of my proof here that we're reversing some of yesterday's, because travel and leisure and basic resources, the two best performing sectors in the stock 600. This is a very cyclical type trade if that's what you're going to go in and buy today. So dip buying to end your week, making everybody happy, of course. We do have a German 10-year Bund yield that's at negative 31 basis points. We have a lot of ECB speakers, a lot of comments coming after that strategic review. And finally, a euro dollar that's weaker today. We have the dollar slightly higher. As you pointed out, Matt, it was higher versus the yen as well. So that taking shape with the policy divergence in the U.S. versus the rest of the world. Here we have the U.S. You have a 10-year yield again coming back. Are the shorts mostly washed out? A lot of the people we've been speaking to say no, they are not totally washed out. But with the yield moving higher, really dictating the move in the stock market, you have S&P futures and NASDAQ futures moving higher in your pre-market session, though NASDAQ a little bit weaker. Again, it's not really growth. It is more of a value type cyclical day. And then finally, break evens. They are moving lower. This is the real standout here. So even if we're taking a break in this sort of risk off type atmosphere, Francine, you still have break evens that are their lowest in a couple months. I think this is about its lowest since March. So there are still fears about the economy, about whether reflation can come back. So sure, maybe you want to trade the reflation trade in stocks, but it fears that this picture isn't going to pick up is still rife within markets.
Yeah, but Danny, that's the one thing that we're trying to figure out, of course, and exactly what's priced in. Also, look ahead at what's going on today. So we start with G20 finance ministers, central bankers meeting in Venice Italy today. It's the G20's latest self-imposed deadline to wrap up global minimum tax talks following the recent endorsement by 130 nations of setting a minimum tax rate for corporations. U.S. Treasury Secretary Janet Yellen will also be in attendance. After that, she makes her way to Brussels for meetings with the Eurogroup. And then coming up in just under an hour's time, the ECB President Christine Lagarde and the BOE Governor Andrew Bailey appear on a panel discussion about digitalization as part of the annual conference of the Global Forum on Productivity. And then data to round off the week coming up at 10 a.m. New York time will, of course, get U.S. wholesale inventories. Now, back to geopolitics, and the Biden administration is stepping up its condemnation of China over Xinjiang. Now, according to a report, the U.S. will add at least 10 Chinese entities to its economic blacklist as early as today over alleged human rights abuses in the northern regions. Bloomberg's chief Asia economics correspondent, Enda Curran, now joins us. Enda, is this just a tit for tat, or is this a turn for the worse?
It's another escalation in the tensions between the US and China, Francine. If you're put on this entity list, that means that US companies cannot deal with these Chinese counterparts without permission from the US government. It's one of the tools the US is using against China, along with sanctions. They've already put bans on imports of certain goods from Xinjiang, such as cotton. This is all about US criticism of China's human rights policies. China, of course, has pushed back. Before I came on air, they again rejected the US allegations against Xinjiang and, of course, its crackdown in Hong Kong. But at the very least, it speaks to ongoing tensions between the world's two biggest economies.
And another concern in China at the moment is the data, whether growth is still on track. We had PPI numbers out today. Do we have any more of a clear picture at this point?
We are getting a hint that China's economy is slowing, Danny. Like you mentioned, their PPI is cooling. It was at a 13-year high. It's now coming off on the back of a strong dollar and, of course, some government measures to take the heat off commodity prices. That will be welcomed by manufacturers. They have been juggling with very high input prices, but we'll get a much better picture next week. We get second quarter GDP data at the end of next week, along with figures for retail sales, and that will give us a fuller picture in terms of what's happening with China's recovery. Is it broadly on track, or is it cooling quicker than expected?
All right, very interesting, especially as both countries start to really focus in on data privacy. To be fair, the Trump administration was pretty focused on this from the U.S. side last year, and now China seems to be seriously concerned about sharing its big data, big tech companies' data. Bloomberg's Enda Curran there. Thanks very much. Let's turn to Venice, where finance ministers and central bank governors from the G20 are meeting. Top of the agenda is the 15% global minimum corporate tax, agreed for the most part at the G7. French Finance Minister Bruno Le Maire spoke to Bloomberg early this morning about his plans.
And let's be very clear. For France, we aim at having more than 15% for the minimum taxation. I think that we need to be ambitious. This is the unique opportunity that we have to have a fairer, more efficient international taxation system for the 21st century.
That was French Finance Minister Bruno Le Maire speaking to Bloomberg's Maria Tadeo. Maria joins us now from Venice. So, Maria, what are we expecting on the tax, minimum tax this morning or this meeting? Are they going to be able to bring it over the line?
Yes, ciao tutti. And, Matt, to that question, on paper, everyone will tell you we're confident we're going to get a deal. But the reality is, behind the scenes, when you speak to ministers here, this is a very complicated story, Matt. On the one hand, the French would tell you 15% is good, but we want to take that higher. Keep in mind, there's no deal yet around the 15%. Then you also have the Irish who say we could work with relocating taxes to the countries where services are provided, but we cannot sign on to that 15%. And then also playing in the background here is the fact that the Europeans are also pushing forward their own EU digital tax next week. For the Americans, this is very difficult to understand. They argue we're now finally getting to an OECD deal, we're getting to a G20 deal, and you guys are still going your own way. So yes, on paper, they'll tell you we're confident come Sunday. We're getting a deal on this. This is a tax revolution. But actually, if you look through the cracks here, there is still a lot pending and a lot of question marks.
Maria, when you look at what exactly this means for some of the big tech companies, could they hurt, or is it actually postponed in the future?
Well, you know, Francine, what they argue is that to some extent they were ready for this moment. You know, this doesn't really come as a surprise. There has been a change in the global conversation around taxes. There has been a political change too, especially in the United States. So they were to some extent ready for this moment to have to pay more. And we are going to see them pay more to that extent where you move perhaps from 12% to 15%. What they argue is that, in fact, they welcome this move because it could make things less complicated for them. You know, they preferred to pay one single tax across the world and not many different jurisdictions doing their own thing. Having said that, Francine, critics do say ultimately these companies are very smart. They know how to play the game. You know, whether they pay or not, 15% effective tax rate remains to be seen. They always find a way to reduce that tax bill.
Maria, thank you so much. And thank you so much for bringing us those beautiful scenes in Venice. What a great backdrop. Now I have very intense FOMO for the rest of the day. What can you do? Anyway, earlier in the show, I talked about how you have this kind of risk-on, more cyclical, even reopening play doing pretty strongly so far. Pre-market, the stocks that are moving to the upside certainly reflect that. Carnival up 2.5%. It's also trading higher in its London-listed stock as well. So this is a sign that people want to go in and buy the dip after yesterday's pretty big fall. I want to give us a check on some of the Chinese ADRs in the U.S. as well, because, of course, they've had a very volatile week. DD actually up more than 4.5% so far pre-market. Look, it's still down 20% since it IPO'd last week, so it's not like this is all clear, but maybe at just above $11, it's finally attractive for people to go back in and buy as we kind of wait to see what the political ramifications are between the U.S. and China at the moment. And guys, I had to do this as my last stock. I'm sorry, I guess. You're welcome, I guess. But I did C-Pop, Chinese hip-hop company. I still don't totally understand what they do or why it has the moves they do. But just to recap, this is a Chinese company listed in the U.S. that for some reason never moves like the other ones that we've seen. Currently down 3% pre-market. But I should say, Francine, it's still up 200% since it IPO'd last week.
Yeah, I mean, I wonder whether they consider it a data company, and so sometimes it just gets kind of like bought with the other ones that they're, you know, trying to crack down on, such as DD. So we'll dig into it a little bit deeper. Definitely the story of the week. Coming up, we talk inflation, markets, and growth. The Christian Nolting, Deutsche Bank International Private Bank Chief Investment Officer. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller, Francine Lacqua, and Danny Berger. Kailey Leinz is off this week. We have breaking news out of China. They have cut their reserve ratio by 0.5 percentage point. Not entirely unexpected, but one more move to help goose the economy as they make some other moves that maybe sap growth a bit. Take a look at this chart that Danny Berger threw together this morning. We see data increasingly disappoint. Not this chart. That's the Chinese yuan cross rate with the U.S. dollar. It's another chart, 914. I have it here in the terminal next to me. And, oh, it's there in the giant terminal as well. So it's on a number of different screens. You can get it by typing G #BTV914. This shows the Citi Economic Surprise Index for the U.S. in blue and for China in white. For those of you listening on Bloomberg Radio, I'll translate for you. The U.S. Economic Surprise Index has come down pretty substantially, but not nearly as much as the China Surprise Index, which is back down into negative territory and has been there for a number of months. Joining us from Frankfurt is Christian Nolting, CIO and Head of Investment Solutions at Deutsche Bank International Private Bank. Christian, the reason I bring this up is that we've heard from a number of people, including yesterday Jim O'Neill told Francine that maybe China is behind the risk-averse market behavior we've seen over the past few days, especially the increasing search for safety in treasuries. How do you view it?
Yeah, first of all, I think it doesn't really come as a surprise, the reserve ratio cut. There was rumors in the market. And if you look indeed at Chinese growth, so we are forecasting quite a decent number this year, but only 5.5 next year. So The discussion also, I think, in recent days in the market was, are we beyond or below the peak growth now? So are growth numbers coming down from here? So I think it's rather positive that China is acting on this, because there was also some discussion, are the central banks now only talking about tapering, and the central bank now again supporting the market, I think is really positive news. But we need to live with that reality, right? So we get a boost in growth, but from there onwards, we probably see lower growth rates. And that's the first reaction we see to that, which I think is a positive one.
Christian, overall, is China the big unknown? So is this why we're seeing quite a lot of movement on treasuries, that we don't exactly know the way forward, the right way to exit, for example, COVID-19, given the pressures on growth we're seeing now in China?
Well, I think there's a lot of, let's say, focus on Chinese markets with the good performance we've seen before. So this year, equity markets are slightly down, right? Then economy, I think, was the first to come out with decent growth, then lower growth going forward. Then the tensions between U.S. China, I think, won't go away very quickly. There was some hope on the Biden, let's say, government to change this, but literally they won't. Why should they? So I think that will stay. So there will be a continuous focus, as China always is, maybe one step ahead, and that could be to the upside, but also to the downside. And that's why that's what we see, and that's to be expected from my point of view.
So in that downside we've seen, how do you take into account equities being so tied to lower yields? Why are lower yields causing the destruction? I mean, hasn't the argument from equity bulls long been that when treasuries are more expensive, all of a sudden stocks are more attractive? What's going on with the link between the two?
Yeah, I think an interesting link to watch is really break-even inflation and equities. So it's a lot about inflation expectations and a lot about, let's say, opening of the markets and equities pricing that in. I think undoubtedly we will stay in a very low, let's say, interest rate environment for quite some time. But again, if you check break-even inflations and the S&P, for example, there was a kind of, not perfect, but a very high correlation. So from that perspective, I think that's where markets are going. So if the discussion is that inflation expectations are not going through the roof, then you see that, let's say, move in equities as well, realizing it's probably not a one-way street out of this crisis.
Christian, thanks so much. Christian Nolting, their Chief Investment Officer and Head of Investment Solutions at Deutsche Bank International Private Bank. Now, coming up a little bit later, Mohamed El-Arian, Gramercy Funds Management Chair and Bloomberg Opinion columnist. So that interview, 9 a.m. in New York, 2 p.m. in London, and this is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Matt Miller and Danny Berger. Kailey Leinz is off this week. Now let's get straight to the Bloomberg. First word news, and Pfizer plans to request U.S. emergency authorization for a third booster dose of its COVID vaccine. Now that's after data showed it can sharply increase immune protection against the coronavirus. Still, federal health officials signal that they would take a cautious approach to potential booster shots. And a new twist in the assassination of Haiti's president. Now, Colombia says retired members of its army are suspected of having taken part in the killing. Well, Haitian police said 28 people carried out the attack against the president. 26 of them were said to be Colombian. The other 2 were described as U.S. citizens of Haitian descent. Well, 4 alleged assassins have been killed and 6 others arrested. And the European Union says the UK owes it more than $56 billion as part of the Brexit settlement. That's more than the UK had originally estimated. The assessment is supposed to reflect the UK's commitments to EU programs it's still benefiting from. Now, the bill could actually trigger more talks with the UK. And finally, junior bankers complaining about long hours and bosses' stressful demands. Well, that won't get any sympathy from Howard Lutnick. The Cantor Fitzgerald chief executive told Bloomberg TV they should rethink their career choice.
Bankers, young bankers who decide that they're working too hard, they should choose another living. It's my view. These are hard jobs. You want to be a doctor, you're going to work hard when you're young. You want to be a banker, you're going to work really hard when you're young. You should know it going in. And make those decisions in life. To complain about it after you got this great job, I don't know, this seems a little silly to me.
Matt Miller has been saying this all along. Matt, I don't disagree. It just depends on whether, it's long hours or it's actually humiliation in doing the hours. So I think it goes back to the culture. And so it's difficult. I would look at it on a case-by-case
I don't think anyone
basis,
disagrees.
But, I'm a softie.
everybody.
I mean, it doesn't matter how much you're getting paid, though. You shouldn't be depressed, right? Like, I feel like mental health.
Well, okay. Here's the thing. I think we all agree with what Howard Lutnick says, but we don't want to say it publicly because we take mental health seriously. It's very politically correct to kind of tiptoe around these issues. But come on. I mean, if you're going to make millions of dollars a year later in life, you got to put in some hard work now. That's just how it goes. Nobody gets to be a partner at Goldman Sachs for free.
Of course. I mean, there's mental abuse and there's hard work, which is why I would say it on a case-by-case basis. Again, we're in lockdown. If you're asked to work like 22 hours out of 24, that's inhumane. If you're being asked, to work 15 hours, that's different. So I'm a very much depends on the case kind of gal.
Not going to get this without competition and hard work. That's just how it goes. And otherwise, you could do something better for the world. Maybe go be a teacher. That would be nice. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Matt Miller and Danny Berger. Kailey Leinz is off today. Matt, the focus, of course, on inflation growth and then the latest news on China.
Yeah, absolutely. I mean, it's really interesting how the market's perception of future growth seemed to change overnight. Obviously, it wasn't overnight. We've seen bond yields coming down for days and days and days. But all of a sudden yesterday, it seemed like growth fears was the phrase du jour. And the China issue, I think, is really complicated and fascinating. Not only are we watching the data, the economic data coming out of China, it's very important, but we're also watching the data, big data, very closely, like who controls the data from Didi, who controls the data from TikTok, and what can you possibly do with that? A lot of great reporting coming out of Bloomberg over the last 24 hours on this.
Yeah, and that, of course, is playing out in the markets, Danny.
Yeah, I mean, look, we are taking a breather here of the intense risk off we saw yesterday. Sebastian Gailey over at Nordea says, look, this is just that. It's just a breather that in order for the markets to really be able to sustain some more growth in the equity picture, we need to see that. We need to see better economic numbers. So far, we are seeing havens. They're not as interesting today. You have a dollar gaining against the Japanese yen. You have a U.S. 10-year yield, which is moving about 4 basis points higher. It's at 133.44. S&P futures not doing as well as Russell 2000 futures. So again, it's a very cyclical risk-on type of day if you have small caps outperforming up by 1.2%. Now, some of the individual stocks moving, if we're going to be feeling bad for billionaires, poor Steve Ballmer slipped a little bit in his wealth yesterday after Microsoft fell. Well, it's time maybe not to feel as great for Virgin Galactic because Richard Branson is going into space, and pre-market the stock is only up 0.3%. I mean, look, granted, it's been up 20% since it was announced, but still, we're not as excited today in this stock as we had been.
It's
General
high risk.
Motors here, it is high, and it's a meme stock too. I will have you know, so that's tied to it as well. General Motors, first they have an upgrade from Wedbush over their EV strategy. Also, a little bit of politics going into this. The U.S. and Mexico reaching a new agreement over one of GM's plants in Mexico over some U.S. concerns over workers' rights. And finally, Stellantis up 2.3% pre-market. They had their electric vehicle day yesterday. They're spending 30 billion euros. Matt, I know you want to get your hands on an electric Dodge, but you can't get the muscle car until 2024. And can I also just say, if they don't call it a charger, they are fools. It is right there for them. It must be an electric charger. I mean, it's perfect, right?
You are so right. I absolutely loved their presentations yesterday. Muscle cars make sense because obviously you get instant torque with the electric power, and the designs are going to be classic 60s muscle. I'm super excited, but yeah, 2024 is the first time we're going to be able to get those.
The sound won't be there.
That's a good point.
No
That's
sound.
a good point. They won't sound very good. It's a loss for the kids. The kids are never going to know how good we had it back in the day. Poor kids.
Yeah, poor kids. We're trying to save their planet, but poor kids. Now, let's get more on that. Breaking news out of China. And China's central bank is cutting the amount of cash most banks must hold in reserve in order to boost lending in the economy. Bloomberg's chief Asia economics correspondent, Enda Curran, joins us now with the very latest. Enda, does this actually fit in the pattern of, the authorities have this, they'll tweak around the edges, but they're trying to make sure that there's nothing ugly out there in the Chinese economy?
Well, it is something of a surprise, Francine. The government did signal earlier this week that they think there are parts of the economy that need support. And now today, the PBOC has come out with this cut of 50 basis points to what's called the reserve ratio requirement. In essence, that frees up money among banks to lend into the parts of the economy that need it most. So, to be clear, the PBOC said in its statement it's not a broad-based easing. They're not about to reverse course. They're still talking about what they say is prudent monetary policy. But I think it does say, Francine, as you mentioned, it does speak to the idea that there are some concerns now over some slowing in China's economy. And certainly there's been evidence recently that China's rebound has gone from a kind of a red-hot pace to something much more of a stable output from here.
I read overnight the Didi crackdown story about China wanting to control big data. I have to say, Enda, it is absolutely fascinating, and to me it also makes perfect sense. I hadn't realized that somebody had published the Didi data showing politicians moving around certain government ministries, and there's just so much you could do with this big data. Obviously, you don't want it falling in the wrong hands. What are we going to see on this going forward?
Well, this is at the center of tensions now, Matt, between the US and China. Technology is front and center, whether it's 5G, whether it's semiconductors, or whether it's developing any of the other kind of know-how that China needs to develop its economy from here. They are starting to get on their own feet a bit more now. They realize the US is trying to isolate them a little bit on this front. Data protection is at the center of that as well. Of course, we know the US had concerns last year over TikTok, and now China's pushing that boat too with its own concerns over where Didi's data goes. None of these tensions are going to go away. The end result does seem to be, though, that China is trying to bring its tech companies back closer to home, to bring them back underneath the dragnet of the central government. That could mean more companies listing in Shanghai and Hong Kong rather than going to New York. And I think this idea of tech decoupling between the world's two biggest economies still has a way to go, has a way to run yet, Matt. And in fact, if anything, it might spill over from technology to other parts of the economies too.
Thanks so much, Enda. As Matt says, it's all about the data, whether tech data or economic data. That's Bloomberg's Enda Curran. Now, coming up, Frederick Pictet Wealth Management Global Strategist. We're going to speak with him about some of the volatility that we've been seeing in markets. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Mohammed El-Erian, Gramercy Funds Management Chair and Bloomberg Opinion Columnist. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Francine Lacqua and Danny Berger. Kailey Leinz is off today. Now, we have been looking at yields falling lower and lower and lower throughout the last, 8 sessions. Is it 8 sessions in a row, Danny? I'm pretty sure that it is. Danny threw together a chart for me. It's 8,400. I don't see it here. There it is. U.S. real yields continue to sink further as well. Tom will often pull up real yields. The ticker is USGG10, T10Y, I should say. Essentially, these are tips, and we came down below -1% yesterday. For our listeners on London DAB Digital Radio, I'll just tell you that I'm showing tips right now for 10 years, 5 years, and 2 years, and they're all way below zero, with the 2 years down at -2.5%, almost. Joining us now is Frederick Ducrozet, Global Strategist at Pictet Wealth Management. And Frederick, I just wonder what this says about the market's expectations for growth and inflation 2 years, 5 years, 10 years down the road. Is it right to look at it that way?
Absolutely. I mean, at least there is a debate raging at the moment whether this decline in long-term yields is mostly fundamentals driven. So as you said, expectations of lower growth, lower inflation, perhaps some obstacles to Fed tightening, let alone normalization in policy rates, so a challenge to the Fed's view, or whether it's mostly technicals driven, because that's also something that has played an important role in the bond market over the past quarter, at least. As a reminder, it's the first time that the Fed bought more U.S. Treasuries that the government in the U.S. actually issued on a net basis. So that was the first time, a support for the bonds, low yields, and it might change in the second half. We'll see. There's a lot of liquidity events happening. The bond market in the U.S. tends to perhaps exaggerate the moves from time to time, and there are good reasons to believe that this growth outlook remains solid over the longer term. So maybe the move is a bit overdone, but I'm careful now with the very short-term outlook in the bond market. Things can move fast.
Frederick, why did actually the ECB in the strategic review didn't go as far as what the Fed in terms of the inflation targeting?
That's a good question. That's really the uncomfortable impression I'm left with today, the day after the strategy review, to be honest, because it was absolutely crystal clear. Yesterday with Francine Lacqua, she said the Fed, the ECB is not doing a flexible average inflation targeting a la Fed. And this morning, if it wasn't clear, the Bundesbank President Jens Weidmann said the same thing. So there's a big difference for markets in terms of aiming at an inflation overshoot in the case of the Fed versus tolerating a moderate and transitory overshoot in the inflation a la ECB. And I think it's all about re-anchoring inflation expectations. That's what we are talking about in the bond market, the long-term inflation expectations and real yields. If this doesn't translate into actual change in ECB policy, which we can discuss in coming weeks and months, then I'm a bit doubtful that the ECB can be successful in re-anchoring those inflation expectations much higher.
Yeah, so Frederick, how tricky actually will communication be on July 22nd? What are you expecting to hear from the ECB? And are we going to see a bit of volatile markets, or is this a non-event for the markets until we get into next year?
To be honest, I wasn't expecting anything. And even the hawks at the ECB were probably preparing for the September meeting to be the big one. The big decision to be made about the pandemic emergency purchase program, the phasing out of the PEP in 2022. And I'm still expecting this to happen. So perhaps this debate can start and an early announcement can happen as soon as on the 22nd of July. But it goes far beyond that. I think the now focus for markets, starting later this month, will be, again, to which extent the ECB translates the new framework into actual policy. And to me, the big missing part yesterday is about the instruments, not the PEP, because this is going to be phased out eventually, but the APP, that's regular QE. Will it be increased from 20 billion to 30 or 40 billion next year when the PEP is phased out? That's my expectation. The dual rate TLTRO, can be extended, expanded, improved? Yes, maybe. And this discussion, again, could start much earlier than expected.
Even with those tools, I mean, can we even get anywhere close to 2%? The ECB CPI forecast themselves for 2023 is 1.4%. Is their policy stance just wrong then, or is this a threat of credibility?
That's a good summary. That's the main focus, if not the only thing that the ECB needs to address. Their forecast for inflation, projection, is 1.4% over the longer term, medium term, which is far below the now symmetric 2% target. Even the Bundesbank is forecasting a 1.7% inflation over the medium term. That's also well below the target. So they have to do something about it. They can't go along with what even Mario Draghi has been doing for years and saying that risks are to the downside and more may need to be done. A lot depends on fiscal policy. No, the ECB now has a new framework. They have to provide an answer to this. And again, my answer would be do more with forward guidance, dual rate, and potentially QE next year.
Is it possible that Jens Weidmann and the Bundesbank trip up the ECB a little bit? He's already coming out and saying things that seem contrary to the goal. He says we won't, purposely push inflation higher than 2%. But isn't that precisely what they want the market to believe they will do?
Yes, again, if they're faced with market expectations essentially challenging their view, they have to respond. Otherwise, it wouldn't be consistent with the new framework that they all unanimously agreed on, including Jens Weidmann. So yes, he's coming up with the usual, caution warnings about not expecting the ECB to do something as aggressive as the Fed. Fair enough. But the Bundesbank itself, when it comes to the projection over the medium term, are missing this new target. So I would expect even Jens Weidmann to indeed push for additional measures, or at least tolerate an increase and an easing in the monetary stance next year when the PEP is phased out.
Thank you so much, Frederick Ducrozet. And thanks to you, actually, Frederick. I also went back this morning on my journey here to work, rereading the Mario Draghi speech from June 2016. He's global strategist at Pictet Wealth Management. I really know how to live it up, Matt, at 5 in the morning. Coming up, we'll hear from the French finance minister, Bruno Le Maire. He is in Venice for the G20. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Francine Lacqua and Matt Miller. Kailey Leinz is off today. Just some news crossing the terminal to break for you. Biden to encourage the FCC to reinstate net neutrality rules. This according to Axios. Of course, those rules had been axed a couple of years ago. This allows people to browse the internet, not have to worry about their broadband providers giving preference to certain companies over another one. This had been a long-standing issue for basically the freedom of the internet. So it looks like the Biden administration wants to make it easier for consumers to comparison shop among internet services as well, as part of what seems to be a pretty wide-ranging executive order that Axios is saying is expected to be signed Friday. They're citing people familiar with the matter, Francine.
Yeah, I love this. I mean, this is also the open internet, and I think Austria, for example, has had it for about 5 years. Now, G20 finance ministers and central bankers meet in Venice this weekend. Let's take a closer look at one of the big topics on the agenda, the 15% global corporate tax. Now, the French finance minister, Bruno Le Maire, spoke with our Maria Tadeo earlier today.
I'm very confident, and I think that we could have, during this G20, a groundbreaking agreement on international taxation. And you know that France has been pushing for that international agreement for more than 4 years. So we are on the verge of having this agreement. It would be good news for all G20 member states. It would be also good news, I think, for the rest of the world.
And you know, the Irish, just to give you one example of the countries that are not fully convinced, they say we can work with taxing in the country where you make your services, but the 15%, that's not something we can accept. When you look at this, is this a full package or can you get to a hybrid solution?
Of course, a full package.
So both?
Both. And we need to have a full package. We need to have, Pillar 1, digital taxation, the taxation on digital giants being decided. And we also need to have the minimum taxation being decided with a level rate of at least 15%. And let's be very clear, for France, we aim at having more than 15% for the minimum taxation.
So how much would you want to see? You know, what are you targeting?
I don't want to give a specific figure, but I think that we need to be ambitious. This is the unique opportunity that we have to have a fairer, more efficient international taxation system for the 21st century, with the digital giants being taxed in a fair way, and with this minimum taxation, which will put an end to the race to the bottom on the taxation system. So once again, 15% for the minimum taxation on corporate tax is a minimum, and France aims at having more than 15%.
And let's just say best case scenario, we get to Sunday, there is this deal, everyone agrees on it, but it will still depend on the U.S. Congress. You also have your own national tax, so what's going to happen there? Are you going to drop your tax? That's automatic. And what happens in the U.S.? Are they going to get this done?
I've been discussing this point many times with Janet Yellen, and we have, as you know, a very good and friendly relationship with the Biden's administration. I want to take a very clear commitment for the French government. As soon as the international taxation and the digital taxation will be implemented France will withdraw its own national taxation. And I'm ready to take not only a political, but also a legal commitment. In the French finance bill for 2022, I'm ready to introduce the commitment that as soon as this OECD taxation system is implemented and enters into force, we will withdraw our national taxation. I really want to avoid any kind of concern for the US people, not only for the US administration, but for the US people. We are fair. We stand ready to withdraw this taxation as soon as international taxation has been adopted and implemented.
Well, that was the French Finance Minister Bruno Le Maire speaking with Bloomberg's Maria Tadeo earlier today. I will also be making my way over to Venice this evening, and hopefully we'll bring you interviews throughout the weekend. Now, let's get straight to Tom Keene, co-anchor of Bloomberg Surveillance, who joins us. Tom, I know you're going to have a conversation about yields, inflation, and
why aren't
growth.
I going to Venice?
Yeah, I'm going to pick you up on the way. Small detour.
You're going to Venice this weekend?
Yeah.
Okay.
That's all there is to say.
Well, what's important there is Maria Tadeo there at Arsenale out on the east side of Venice. And as you know, that's where the Venetians defended themselves, Francine, against the evil people of Genoa. I mean, the only reason they could fight off the Genoese is the arsenal.
I think my only opportunity, actually, to talk about the football is the fact that there's a number of memes going out saying it is Genoa, so in fact it's the Italians. They also gave the St. George's Cross to the English to protect them in the medieval ages. There you go. Should we talk markets?
We should talk markets here with a recovery today. We see it across equities, and where we really see it is the inflation-adjusted real yield. There's a lot of research notes out saying, okay, there was a growth slowdown, and we come back here, and just an indication on an intraday chart of how we've come back. We've come down. We've come back about 3/4 of the way this morning, and there's some enthusiasm to that, bouncing back, Francine. Into earnings season next week, it's a growth scare, and maybe it's over.
Tom, I'm looking forward to it. I'll send you a postcard from Venice. Tom Keene,
Please send me
Bloomberg
a postcard.
Surveillance.
Really?
Now we'll look at what else we're watching today. Danny, you're watching space.
I am, yeah. If Tom is impressed you're going to Venice, I wonder how he feels about Richard Branson flying off to space on Sunday. This is, of course, in the battle of the billionaires, of course. They are saying, Richard Branson and team are saying that Virgin Galactic speeding up, getting him into space this Sunday has nothing to do with Jeff Bezos making the same trip with Blue Origin 9 days later. In kind of looking at the story, it is interesting to see that he has done some thrill-seeking things before. Branson in 1998 attempted to be the first to fly a hot air balloon around the world. He didn't make it, unfortunately. Hopefully he has better luck this time.
Yeah.
Well, I mean,
we hope so.
No, he does this kind of stuff all the time, you know? I mean, he's a kite surfer down in the BVIs. Good on him. Although I will say, I believe Bezos is going to go higher. I think Branson's going to go 55 miles and Bezos will go 62. We don't know until it happens, and I really don't know what it means. But I'm going to be watching President Biden. He's going to sign a sweeping executive order today to promote competition. At least that's the idea. Part of that is going to reinstate or try and reinstate net neutrality. And also, we're going to watch what he does in terms of data safety, because the Chinese have tried to take some of their data back, and he will as well.
Right. I'll be watching the G20, and we have a great interview coming up on Monday. This is Bloomberg.